Hello, folks. Bill and Brian here, and it's Wednesday at noon Central Time, and we are here to talk about the market real shortly. So before we get to that point, Brian, let's roll the logo. Hey, folks, listen, welcome to our little talk. And Brian, we're going to be talking about peak oil. And we're not talking about Chesapeake. We're talking about peak oil. And we're going to try and start to buy. What is your definition of peak oil?
Well, one misconception, and we should talk about Chesapeake at some point, with their acquisition of Southwestern, they've kind of rebounded, but
Yeah, it's going to be a strange thing here in Oklahoma City.
yeah. Well, I mean, are they going to relocate the headquarters to Houston? How is this all going to work?
So basically what I've heard, and from people who are affected by this, is that they're going to keep just the corporate personnel in Oklahoma City. All other personnel will be moving to Houston.
Yeah, that kind of sets the stage for some longer ones. Well, so listen, folks, we're going to talk for about 30 minutes. I'm still fighting some winter congestion, so I'll try and keep that to a minimum, but Bill's going to help me out with that. One of the things that we wanted to talk about in oil and gas is people talk about peak oil. Well, what does peak oil mean? And feel free to ask questions along the way. We're going to be here for about 30 minutes. So we will stick around and answer questions. We are just going to touch on the market. We're not going to go deep on that because we're really going to try and stay on topic on what peak oil is, what it means, and are we there, right?
Correct.
That's what we're going to try and solve. So first things first, we are going to do a quick hit on the markets. Natural gas has dropped off the highs, come back down to 280s. Crude is struggling to get over 72.95. That's kind of a key spot. Now, a big reason that natural gas has taken a dive from, look at this, all the way up at 330 last week is because of winter forecasts. So, and we keep track of that right here. So let's take a quick look.
Which, by the way, we keep track of that on Energy Rogue, and you can get Rogue Edge for $89 a month. We do have a premium service that gives you a lot more for $179 a month. This is all available to you, the consumer.
Yes.
Yeah, rogueedge.com or energyrogue.com.
Yeah.
So you go to energyrogue.com, you come down here, Rogue Edge for $89 a month. There's all your features. Rogue Premium, $179 a month. And with all its features, and you get with the premium, what you also get is access to the Discord channel where we every day, it seems like all day and all night, we talk about the market. So if you're up late, if you hit out there, I promise you there's somebody watching just about 24/7, mainly because we have people from all over the world looking at it. So that's what you can get with Energy Rogue, Rogue Edge, and Rogue Edge Premium.
Yep. So one thing about Rogue Edge, it's attracted attention from all parts of the globe. So not only here in the United States, but people in Europe, people in Asia, people in the Middle East. So it is
in all segments of the industry as well. So it's not just buyers or sellers.
We have people producers, consumers, midstream traders, hedge funds.
They're trying to figure out. They're trying to make business decisions, and they need a little bit of foresight to be able to do that.
Yep.
So we were talking about nat gas struggling to get back up above 3. Crude oil struggling there at 72.96. And then there's the weather. Now,
So
these
natural
always,
gas, this is the reason it's struggling right
and
there.
this is always gets me because you have to look there to see this is what's above average. It's not above where it's at right now. It's not above anything. It's just above average. And so it's not real degrees. It's above average. Can I say that
Right.
one more time? It's above average.
Well,
Average is calculated. It's calculated in this case what the climatic median temperature has been from 1991 to 2020. That's what's average. So it takes those 30 years, averages all the temperatures, and this says this year will be above that average or these 8 to 14 days says that parts of the country will be, and I don't think that means well above. I really can't read the margin down there, but it's not as it may be 3 or 4.
no, actually, the orange. This is another misconception. The orange means the percentage of likelihood.
Hmm.
So it
It's a
doesn't
probability.
necessarily.
Yeah.
It's a probability. So the darker orange that it is, the higher the probability is. So right here, for example, this light one is maybe 33 to 40% above. Now, bear in mind, weather models change, and we track these and actually have near-term weather models that we piggyback off of that capture what's happening on the degree days. But essentially, the reason that natural gas has dropped all the way from 330 down to 280 is because of weather outlooks. So
So
that's why natural gas is struggling. Crude is struggling because of, well, today because of strong dollar, and Saudi Arabia cut their oil price to Asia.
right.
So those
And
are
those are
two
two of the
things.
factors. Just remember, and we will always say this, it's never just one thing.
Right.
There might be one thing that's influencing the majority of the move, like the weather in the case of natural gas, but the amount of supply is also doing that as well. And so it's always more than one thing because in natural gas, you got to look at weather, you got to look at imports, you got to look at exports, including LNG. Then you have to look at supply. You can't just say it's one thing.
Whatever you do, don't fall asleep.
Exactly. Do not fall asleep.
That's part of the reason that we set up Rogue Edge, because we wanted to offer insight into what's happening in the industry, and Rogue Premium is really designed for more custom insights. So, for example, in our Discord channel, as part of our premium, there was a great question this morning. EU storage at 78.5% seems way above normal. Could our exports slow down later on this year or have cargo cancellations? So I responded with a video where we walk through that potential of likelihood. These are important questions, and that's part of the reason that if you are in the business and want to understand what's happening in the market, Rogue Edge is going to give you the basic building blocks, and Rogue Premium is going to give you insight into specific questions that are impacting the market. Does that sound right?
That's right. So it's time to get back to our subject of peak oil. So let's talk about what it means by peak oil. So in any decade, in the 4 or 5 decades now I've been involved in the industry, there's always been a peak oil moment, and where everybody says, "Well, this is peak oil. Well, this is peak oil. Well, this is peak oil." What was that? That was only 3 times. I should do it 2 more times, but I'm not going to. Peak oil has, in my opinion, I don't think if this is even Brian's opinion. In my opinion, peak oil has more to do with finance, politics, and geopolitics than it has to do with geology. I know that sounds so, non-scientific, but the bottom line is that at the right price, we have a lot more oil that we can go get. The problem is that it's not going to be the right price because you really should be more concerned about peak demand than peak oil. And so people say, well, peak demand is about gasoline. Yeah, it is a little bit, but remember, gasoline is basically only about 40% of the oil barrel. And diesel's probably another 35 to 40% of the oil barrel. So what's the other 20%? It's everything from plastic stuff, petrochems, it's asphalt. It's
close this coffee cups.
right. So if we hit peak oil and that goes down, your everyday life is going to become expensive. So that is some of the things that you have to consider when you talk about peak oil. Have there been times when the production in the United States has peaked and has slid back down? Absolutely. But every time it slides back down, the economics come back up to be able to do that, and the industry goes out and finds new technology. I mean, we are just now entering the 10th year, maybe 9th year of horizontal drilling. That's not very long in the industry. So, Brian, let me give you a little bit of history lesson.
Okay.
Do you know what a buggy whip is?
You mean with a horse and buggy?
Yeah.
No. What is that?
A buggy whip is all it is. Just that they sold a lot of them when they were driving buggies instead of, and that was their main means of transportation. The buggy whip industry peaked. You want to guess what year?
Right before the car or after?
It was after 1915.
Okay.
Okay. You know when the last buggy whip manufacturer went out of business? This one's going to surprise you.
1970.
2020.
Whoa. Wow. Okay.
Yeah. Blew me away. But you know what's funny? You can still buy a buggy whip.
I guess a used one.
Well, no, it's not what you think. So a company has come out, and have you ever seen these side-by-sides? It's got the little sticks in the back. They've got the lights on them.
Yeah.
They're called buggy whips.
Ah, okay.
So what I'm saying is sometimes you'll see an industry peak, come back down. They'll peak even after their replacement has arrived on the scene. And so I don't see I think when we talk about peak oil, we have to think about, okay, what's the price of oil? And folks, the price we have right now, if you went back to the 1970s and did an inflation equivalent, we should be at about $140 if I remember my math right.
Actually, it's 400. Depending on when you take the point in time, there are inflection points on the crude oil price. Some of those are as high as 400. Some of them are we should baseline be 140.
Right.
So by inflation standards.
We currently have cheap energy, is what I'm trying to say. Cheap energy drives it. Peak demand, yeah, you can say, oh, well, we're all going to go electric cars. That's a whole nother argument. Actually, that's a 2 6-pack argument because you're going to have to be semi-drunk before you actually try to believe either side. But the point being is that we still have cheap energy. Peak oil is talking about what we can produce. So let's talk about politics. So if it's not finance, there's got to be politics or geopolitics. So let's talk about politics first. There are restrictions in place that's going to try to keep the production of oil down. It's just how people feel about it. I don't care what political flavor you are or color you are or whatever it is. There are people who have sold the narrative that oil is bad. Now, my personal opinion, it has provided me a living for many, many years, and I've seen it do a lot of great things. But we don't look at that. We look at always at the negative. Why? Because negative sells. No matter what you're doing, negative sells. What's the newspaper term? If it bleeds, it leads. There you go.
Yeah.
Negative things happen. So that's the politics. Then the geopolitics part of it is, I really don't think the people that are in these poor countries want to remain that way. And the way you get out of poverty is with cheap energy. And so you have to have cheap energy sources.
You have to look at the evolution of society when they go to an urban type setting, such as China. China is a great example. Is it went rural to urban, and as it went urban, the energy usage peaked. There is not peaked, spiked, and so the energy consumption increases. And the fact is, there is only a finite amount of energy available on the earth. Now, we are only scratching the surface on what could be harnessed from the energy consumption. And politics aside, there is an environmental impact on oil. There is an environmental impact on renewables. All of it is a very debatable and very challenging, because it's gotten politicized, and it shouldn't be politicized, because the answer is, as a globe, we need it all. And so it's not oil or renewables, it's both. Because let's put it this way, if we increase Teslas by 10% in the United States, that guarantees the existence of coal burned power for the next 5 to 10 years.
Easily.
And there's structural reasons as to why. If you want to find out about them, reach out to us and connect, because there's a structural reason that it guarantees the existence of coal. So we're not actually going forward, we're going backward, because there's a critical value chain that is being ignored in the debate. So
the other thing to understand is that anytime someone moves from an underdeveloped nation to a developed nation, their carbon footprint goes up by anywhere from 6 to 10 times.
Yeah.
I'm not saying that shouldn't happen, but the results of some of this can be very devastating for countries and for specifically individuals. So all that to say this is, peak oil has more to do with people talking to people than it has to do with geology. And so as you begin,
finance,
finance, but I mean, it's people who drive the finance. And it is important to understand that when we talk about peak oil, we're talking about a single industry. And if you haven't figured it out yet, everything runs on oil. It just does. We have designed our modern society to where everything runs on oil, even if it's lubrication, whatever it is. It's lubricating for electric motors. And to change that society to that type of driven society doesn't happen in a period of 10 years. It happens in a period of 100 to 150 years. And so if we want to be smart about that, we have to look beyond the end of our lives.
Are you trying to start a fight? No, I'm simply stating
a fact.
Okay. So
what I'm saying is when you talk about peak oil, look at the long term, look at the history. You'll see that we've gone up and down. And I don't believe we're at peak oil as far as availability of resource. We could be at peak oil on the availability of production until something financially changes, politically changes, or geopolitically changes.
Yep. So the first thing that we'll cover today is the fact that for those, some on the live stream are going to understand this, some are not. When you drill an oil or gas well, it declines. The day one production will be the highest point of production that the well will ever have, unless there's mechanical intervention into the well. So this is let me take you to here. This is a oil well in wolf camp. First month, 1,380 barrels a day. Month 12, 217. So
what that
this is
says is
called
you have
the
to keep
tail.
right. When it flattens out in the back end of the curve, and so it's not as important. But those first 12 months, you lose so much of that. You have to keep drilling in order to keep that level of oil available. And so that's when Brian and I look at rigs. If there's not enough rigs turning, it's hard to make up that decline in an oil well. Now I hear about the efficiency of rigs and I understand that, but I mean, the most efficient rig that's changed has been 25% more efficient. Not every rig has that technology. So I would say that we're probably somewhere around maybe rig efficiency could account for maybe a 12% increase, maybe.
Well, from 2008 to 2015, there were leaps as far as gaining 30% year over year on efficiencies. Those have stabilized and come down, and maybe we get 5 to 10% more efficient each year. But a lot of people look at a production curve over a period of time and they stop. In other words, they say, well, look at this growth. It's just never going to stop. But they don't look at what might be driving it. And that's part of the story here. This rise from 2018 to 2019 is because of these rigs that were from 2017 to 2018, 19, and then we started dropping. And what happened to production, this natural gas, similar curve on oil, natural gas production dropped significantly. And now this is due to COVID. Yes, there was a supply demand shock, but there's a direct correlation to when rigs drop, there will be a supply response. Now, how much depends on where you are on the decline curve and the stack of new production, right?
Right. So we track this, and one of our most fascinating charts, I guess we don't really show it that much, Brian, is when we start tracking all those different years. I think you've got that down a little bit lower, where we have all the different zones and yeah, that's it. That's the one I like.
So this one basically takes the vintage of the well. These are by months, and this was for an academic purpose. But this shows you what is needed to keep, and this was for the Permian. There's one more. There we go. The Permian Flat on natural gas production. And what you can see here, let me take off the base. So if we just have the new production, this is starting in 2022. What you can see is we've been building and building and building and building. But if we don't have rigs, this is what happens. It takes us from 5 BCF a day down to 3 BCF a day within 12 months. So the fact is, you need to continue to add, and that's part of the reason that what we take a look at when we're looking at production, supply, and demand is we take a look. Let me get it here. This is on oil, and we carve it up by basin. Our oil declines by over 600,000 barrels a day every single month. On 13 million, that's a lot. So that means we need to bring on new production in excess of 600.
So everything Brian's showing here is actually on Energy Rogue Edge and Energy Rogue Edge Premium. And you can make these correlations yourself. You can look at them. You can move these charts around. You can download them and put them in your own presentation. We make this all available to you guys for those two prices of $89 a month or $179 a month. And this allows you to be able to present to either management or to people or to argue with your favorite uncle. It doesn't really matter how
Right.
you use it. But you can use this to begin to show what's happening. And we track all this. There's over 100 charts that are out there that you have access to. And they show, and I believe is that our net change right there?
That's
So
it.
this is the oil net change. What happens is that we track declines versus new production. This tells us that we dipped down below, and I think we're just right at flat right now, aren't we, Brian? That's what it looks
Yeah,
like.
it basically says that as a nation, we're kind of treading water, and you can see that on some of the weekly reports. This is a monthly frequency, but this shows us by basin what is happening on growth, on new production, and declines. So we split that up, and then we take a look at how that's going to impact the aggregate. And let's touch on a few things, and feel free to ask questions while you're watching here, because we will field those questions. But the main thing to consider is when we look at rigs and we look at what has happened since 2022, these rig drops haven't been felt on production yet. But as natural gas is showing an indication, it's starting. And that start is going to continue until we add more rigs there. But I want to show something, and that is two charts. One is when we talk about horizontal drilling. This is a length of laterals. These wells are more efficient because their drilling costs have skyrocketed. They're more than 2.5 miles long.
Once they get, so basically they go down about 10,000, between 10 and 14,000 feet, and then they go horizontal drilling, and they start off at a mile, then they start off at 2 miles, and now they're out to 2.5 to 3 miles. And what that does, it gives them more contact with the producing zone that one well can have, and that's why you see these huge wells coming in, as opposed to any vertical well. You'd have to drill, gosh, Brian, I think you'd have to drill somewhere around 30 or 40 wells to be able to get that same amount of return, or at least that same amount of contact with the producing reservoir.
Yep.
And so that's why you see horizontal drilling. It was a huge technological change in the industry.
Yeah. So we have aggregated, and we share this with our members, what a new well produces on an IP. And I took a look at Permian, which is one of the best economic plays, and on the initial production, you have a well that will produce $2 million, $2.2 million on average for the first month. That's great. You know what it is after month 12? What do you think, Bill?
So 2.2, so that means you got to be down to less than 500,000 easily.
Yeah. So it is 300,000. So in month 1 you get 2 million. In month 12 you get 300,000. So if I average that out and kind of smooth out things, you may have a year 1 payback of $11 million. But what does it cost to drill a well? There are some indications that it's going to cost anywhere from 10 to $20 million, right? So
and that's to drill a well. That is not
that's not
connecting to
too,
the well. That's not 1 year's worth of maintenance. That's not any of that. It's just that's the initial cost to drill.
yes.
That is not the only cost that's there.
So so when you look at that, the range of outcomes can be significant to where you could have a high producing well that gets you a 13.2 million payback in year 1, and a low well at 7.7. So if you've got a well that gives you 7.7 in the first year, it's not going to pay back for probably 9 to 10 years. That's a terrible investment. That's the reason this industry is so dependent on new production and drilling economics. But that's the reason that this visual is important, the length of the lateral, because
So,
that increases cost to drill.
so now to set up what we were talking about, we talked about has oil and gas production reached its peak. And I'm going to say we could be at a peak financially. I do not believe we're at a peak geologically. And so I think we might be at peak financially. And one of the biggest things affecting that peak is the politics. When you get into geopolitics, things change a little bit. But just remember, geopolitically, in the energy industry, the U.S. has less influence in oil, probably more influence in gas. And so it's going to swing back and forth in that group because of the LNG and on the crude oil. It's because the crude oil that we are developing in the U.S. right now is a lighter blend that can't be processed in our refineries that we currently have operating today.
Yeah. So put simply, peak oil, peak gas is going to depend on what the price is. Because what is your favorite saying, Bill? At $2.85, we may be pretty close to the peak.
Right.
At $6,
Yeah,
no.
we haven't started yet.
So it's going to be a function of dollars and cents, because if you have more dollars, then you can afford longer laterals, but longer laterals actually drain the resource faster. So there is kind of a balance between time, money, and production. So that is kind of the central point of the argument. And the short story is, it's going to depend. It's going to depend on what the economics are and what the resource is going to have. And again, if you want to take a look at the spreadsheet, reach out to us. There's information down below. And we'll cover it with you in a call. Would love to see you sign up and have this as part of your initial sign up. So,
and remember, folks, always avoid those companies that have more dollars than they do cents. Oh, that meant a different sense. See what I did there?
I do. I do. But well, anyway, we just scratched the surface because there's a variable we haven't dove into as far as drilling costs, but the value of a particular well, and I'll go back here for just a second. What you can see here, let me blow this up. What you can see here is that, go down just a tad, is the reason why Permian wells are so important is because it's some of the best economic returns. Niobrara is up there. Eagle Ford is up there. Utica, boy, that's kind of lagging. Utica and Haynesville. That's going to be a function of gas price.
Right. They're mainly gas plays. That's why that is.
So listen, I think
we have a question, Brian.
What's the question? John, thank you. Thanks for watching. Would you have any info on the withdrawal tomorrow for LNG? I think you mean the natural gas storage number for tomorrow. The range that I have heard, and again, this was out on our Discord this morning. Let me see where that is. Let's see, the withdrawal range, 165 to 116 on the withdrawal. Hopefully this is the right question that you're asking. Last year was 68 BCF. 5-year average was 126. I'm actually surprised that this range is only 165 to 116. I'm pegging it close to, I think we might surprise and get anywhere from 160 to 170. That is a pretty bold guess, I'd imagine. But
I think it's going to be at the top of the range, Brian. But I think we have to remember that storage number is going back to last week, not this week's gold.
But this is part of what we talk about in our Discord channel, and that's part of the reason the The Rogue premium is $79 because we're not just covering technicals, we're covering fundamentals as well. So I would peg, and again, the range was 65 to 116. I would peg it closer to the 165, which means it's likely to have a bullish impact. That said, there's some reasons. If you're looking at trading natural gas, there's some reasons to have concern, and a lot of those have to do with this, as well as the March contract. The March contract is trading about 250. Traditionally or historically, February and March trade on top of one another. There's going to be convergence in the next 10 days. So either March is going to come up or Feb come down.
Okay, well, we're going to say that traditionally there's been convergence because we just went through a winter where we had 1 month where there was no convergence.
Yep. So John, greatly appreciate you joining. Thanks so much for listening in. Hopefully that answers your question. And feel free to drop us a comment if it didn't, or reach out to us directly. We'd love to be there for you on the LNG. And again, this was a topic of conversation where we talked about EU storage in our Discord channel. I mean, so there's a lot of value in some of the discussions that we're having on the Discord channel. So, all right. Hey, thanks so much, John. Appreciate you. Let's see. What are your closing thoughts, Bill?
My closing thoughts are, when you talk about peak oil, we're back to get to the same thing. It's never just one thing. So when you talk about peak oil or peak gas, you have to take all the other influences over the financial influence, political influence, and geopolitical influences. And at any given time, all those are going to go one way or the other. But I think that we are seeing some struggles right now because of for gas, we had a mild start of winter. And for oil, people are still not back at work. They're doing most of their work from home. A lot of people don't work from home. So that affected demand on the commute. And I think as any of that begins to change, we'll see that. I think the biggest change that's going to be in our world is going to be underdeveloped nations developing more and more because they're going to need cheap energy and they're going to go to the fossil fuels to do that. And that is my closing thoughts is, it's sort of like watch India and China, and really the African continent has starting to have a lot of influence on demand as well.
It's a mystery wrapped in a riddle inside an enigma.
Exactly. That's what I say. I'm not sure that's an agreement or an opening.
Yeah. So listen, thanks so much. If you learned anything or we helped in some way, drop us a like, drop us a comment. Really appreciate it. Any sharing and that engagement really helps us get the message out. So thank you for showing up. Thank you for being here. If you have interest in connecting with us, there's information down below. We would love to hear from you. So
all right, folks, stay out there. Be safe, be warm, be kind.
Be safe, be kind, be warm. I like that. So listen, thanks so much. And we will see you next week. If you miss this, there is going to be a replay out there. So see you soon.